Hi, this is Scott Murray, and welcome to the Daily Economic Market Shout for Friday, April 14th, 2023. It's great having you with me here today. We got retail sales numbers. They were disappointing, coming in at negative 1%. But you look down, you remove autos, remove gasoline, you got a better reading, still negative. Gasoline was almost 5% down. Good news for the consumer. On reverse, unfortunately, however, it was a good element for the consumer, as I mentioned, and that kind of took off some of the inflationary concerns, but it did dent the number. Autos still were having troubles getting supply up, still under 15 million. And I do think that the consumer is really trying to take a pause. They're kind of exhausted, and they really worry that they're paying too much. Pricing hasn't come down. Again, we're talking 48,000 for an average new car. It used to be 37 before the pandemic. Yeah, I know it's got a lot more bells and whistles than it used to have, but we're seeing a lot more over MSRP pricing, and that's really worrisome to the consumer, which is paying 70-month loans to get into a car. Quite expensive, particularly with interest rates moving up towards 10% on vehicles. So that gives us a sense that there's a pause. If we look at the control group, that's the mimic of consumption and gives us sort of a reading on GDP. That tells us it was modestly negative. We've had negative prints, but remember that January was a whopping gain. So consumption in the first quarter should be positive, and that should keep the economy on a growth metric. Still expect investment to be quite weak, and a little bit of a pickup that we've seen from exports is actually going to help us in the numbers. But if you look down, you see the secondary categories, you still see the weakness. What you should note also is the incredible pace we've come since the pandemic. Just look at the category of non-store retail. 66 billion in sales in February of 2020. Today, we're doing 115 billion. So a lion's share, a huge increase in that category. And that's really a huge part of the economy right now. And we're still struggling to get it there. Yes, it still grew. And food is another category that has done quite well over that period of time. Now, the more traditional categories like department stores, mass merchandise, even apparel, we're starting to see some weakness. And then if you get down into the housing elements, people are really hunkering down and not doing much with housing right now, kind of waiting out the elements. So we had negative numbers on the housing side of the equation. So yes, the consumer looks tired. This shows a narrative of kind of struggling to keep up. And even at this lofty level, a movement back would not be terribly surprising. And remember, that would be a negative GDP. And so that would constitute as a recession. And we would expect the recession to come after we saw the inversion of interest rates. So the narrative continues to build, but we should know, because of the high level of jobs and those elements, that this downturn that seems to be pointing towards the end of this year should be mild in its nature. This is Scott Murray for the Daily Economic Market Shout. Thank you for joining me.